Welcome on board Ed Yardeni, the President and Chief Investment Strategist at Yardeni Research, joining us on the show. Yeah, hi, good to be speaking with you. Thanks so much for making time and speaking with us. Sure. Well, I don't know what changed, but suddenly last week you had the S&P notching the best week so far in 2024. The Goldman Sachs analysts have cut down the recession estimates back to 20% versus 25%. Right. What really transpired? You think that there has been this big change within a couple of weeks itself?
Well, I think it's certainly been an interesting couple of weeks. 2 weeks ago, when the employment report came out, I think it was August 2nd in the United States, the knee-jerk reaction was that it confirmed that we might actually be in a recession or very close to a recession. And so I think that was part of it. Also, just by coincidence, the Bank of Japan started talking about raising interest rates more aggressively. So on August 2nd, that Friday, and then the following Monday, we continued to have a big sell-off. And I think a lot of that was really related to unwinding of so-called carry trades, where speculators had borrowed at zero interest rates in Japan and converted that into other currencies to perhaps speculate in the Magnificent Seven, perhaps in the NASDAQ 100, in Mexican and Brazilian currencies. They also put money into the Nikkei, which on Monday, following the Friday report, was down, 14%. So it was really pretty ugly. But I think within a few hours on Tuesday evening, New York time, the Bank of Japan came out with an announcement that they were going to hold off on being too aggressive in raising rates. And suddenly that whole carry trade unwind just and the market started to stabilize. And then last week, we had some really good data on retail sales, and initial claims weren't so bad. And suddenly the recession fears abated. So it's been...
Yet, imagine if someone went on a 15-day holiday and you come back and do a check. Looks like nothing has changed. Yeah. It is back to momentum. It is back to the Magnificent Seven, which are rallying, and it is back to a strong global liquidity surge. I mean, looks like, even though I know there is a storm in the area where you are right now in, but for financial markets, the storm has come and gone.
Yeah, well, the storm is gone here too, so the internet connection is still solid. But yes, I think you're absolutely right. I wish I'd taken 15 days off and wouldn't have gone through that roller coaster ride. But those of us that are in the market are in the market, and we're watching the market. And I didn't believe that the sell-off was fundamentally based. I still think a lot of the weakness in the employment report for July had to do with the weather, particularly Hurricane Beryl, which went barreling into Texas. And there was other indicators that came out, like housing starts for July were very weak, but all of that was driven by a massive drop in housing starts in the South. So I think this sets us up some pretty strong economic indicators for August, which will be out in September. And September is when the next FOMC meets. So I think when Fed Chair Powell talks on Friday, everybody will be listening. And I think he will more or less confirm that we're probably going to get a 25 basis point cut from the Fed in September. But I think he's going to be cautious about more rate cuts after that. I don't think he wants he wants to push back against the market that there's just going to be one rate cut after the other because the economy needs it. The economy really doesn't need it.
And then just Jackson Hole Symposium at the end of the weekend, what are you expecting in terms of the big comments from the central bankers? Anything that you're specifically watching out for?
Well, everybody will be tuned into the Fed Chair Powell's speech, and I think he'll be somewhat dovish, but if they're looking at the economy the way I'm looking at it, and that it's not as weak as people thought only 2 weeks ago, they might be cautious. He might be cautious about signaling more than a rate cut in September and just saying that anything beyond that is going to be data dependent. But there will be other central bankers attending that annual conference in Jackson Hole. And we could have somebody from the Bank of Japan saying something about the carry trade, and I think they're going to continue to maintain a cautious line on tightening. But then again, their economy is strong. In Japan, 3% real GDP growth in the second quarter, and then of course their inflation is above their 2% target at 2.8%. So they do need to raise interest rates, but they really can't because of the unwinding of the trade risk happening again. And the Fed really can't cut rates too much because that too would create a carry trade unwind. So I think the central banks are kind of limited in what they can do by the market reaction that we've seen over the past couple of weeks.
And, thanks so much for taking the time out and staying up late in that storm for us. Good speaking with you. Well,
if you like this video, then like, share and subscribe to ET Now.